So we all understand the facts. We know where we are. We know where we've been. What we're going to start looking at is planning what we're going to do either now or in the future, or either now or for the future, to help us reduce our tax liabilities. Okay? So here and now, if I have distributable reserves within my business, should I declare those as a dividend? Take the hard choice of paying the tax, which will fall due on the 31st of January 2017, but in the knowledge that actually the rate of tax that I'm going to pay on that distribution will be 7.5% lower than if I leave that in my business undistributed. I can't answer that question for you because it depends on more slides to follow if there's other options available to you. And also, it's your choice when you take a dividend and when you pay the tax. So very worst case, or better case of a worst case, if I had £25,000 sitting as distributable reserves in my business that I knew I wanted to take over the next couple of years, and I didn't really expect anything in my life to change, then prior to the 5th of April 2016, I would make that dividend declaration. What we can see in our packs is that that dividend that we declare, we're bound to pay less tax on it. There's the cash flow point that I actually have to pay the tax. But on that extra £25,000 dividend, if I already take a £30,000 dividend from my company, then I'm going to save tax of £2,902 just on the marginal rate by taking that 25k prior to the 5th of April 2016. Now, what you may be sitting here thinking is, my gosh, I can't afford for all of that money to be taken out of my company. I need it as working capital. We understand that completely. Remember that dividend tax is payable when we declare a dividend. When we declare a dividend, we don't have to pay the dividend. We can leave it in our company as working capital, as a loan that the company owes us that money. And when we draw down on that loan, there's no tax implications of taking that money out of the company. And there's no tax implications for the company when we draw down on it either. So if nothing else interests you over the following slides and you find yourself in that position, let me know. Let's run the numbers and see what it would look like for your business. Moving on to our next consideration that we should always bear in mind, and things that maybe we should be considering doing now rather than waiting until after the 6th of April, is quite a few of us are going to own a dividend portfolio, or a share portfolio, sorry, outside of our own company. So in all the case studies that we're going to talk about, we're assuming that the only dividend income that we have is actually the dividend from our own company. But what about my shares in Thornton's? What about my shares in Aviva? What about my shares in Boots? And that strange sports company and the strange oil company that'll never pay me money back, honestly. But it was a good idea at the time. Well, those dividends, when they're paid to me, they're biting into that £5,000 nil rate band before I even start taking money from my own company. I have one £5,000 nil rate band, and that has to be used for the dividends from whatever source I receive that money from. Now, my lines are always the same. I'm not a financial advisor. I can't give financial advice. But things that maybe you should be considering and things that maybe you should be talking to a good financial advisor about are things such as using your stocks and shares ISA allowance, because the dividends paid from an ISA are free of tax and don't affect our £5,000 nil rate band. If we have a large portfolio, then maybe we need to consider moving the right shares into our ISA by looking at the yield, those that we're perhaps holding for capital growth as opposed to dividend income. And we also have venture capital trusts. So if you're a bit more of a risky investor, then those dividends from those types of trusts are actually free of tax. As I say, not a financial advisor, but definitely worth thinking about and looking into. Okay, the thing we all fail on, and I know you fail on it because I'm as lazy as some of you guys, is the best way of actually taking money from our company is to claim the right amount of expenses. Why are we doing things on behalf of our company that we don't actually claim our expenses against? Oh, I just popped to the bank today. I didn't put it on my mileage log. Oh, I probably won't claim my use of home allowance this year because I only work 6 evenings a week at home. So the revenue might actually ask me some questions because I rent an office Monday to Friday. Well, what that used to cost me was 200 quid in corporation tax if, as an example, I didn't claim my expenses of £1,000. So my expenses were £1,000 short, so I paid an extra £200 in corporation tax. I declared a dividend of £800 and I didn't pay personal tax on it. Well, that's about to change, isn't it? So what you have as an example in your pack under the expenses to reclaim section is an example just about what the costs are of poor expense maintenance. If my company profits are £30,000, but actually if I kept my records as accurately as I could and should, then I would have profits of £29,000. Well, as a basic rate taxpayer, you can see the £200 in corporation tax that I have to pay, but you'll also see I'm going to pay £60 in dividend tax. So actually that £1,000 that could be withdrawn from my company and be in my pocket, I've now lost £260 of that. As a higher rate taxpayer, maybe declaring profits of 60k, and I should be declaring profits of 59k, well, that personal tax on my dividend of £260, wouch. So my £1,000 that I could have by keeping my receipts and understanding legislation, I actually have £540 in my pocket, and the revenue have £460 that you nor I want them to have. Okay, so what we've included in our pack for you today at Appendix D is a section that comes as a chapter in our book. For those of you that don't have a copy of our book, we have a detailed section on expenses that are available to be reclaimed. And what we tend to do is when we go and buy stationery, we have a receipt, we put that through our accounts. What we're not so good at is can we clean a complete and full and accurate mileage log, as an example. We're not very good if we have a bicycle that we use for business of keeping a bicycle log. Entertainment scares us, so we go, oh, I'll add that back, it's not a deductible expense. But that's not always the case. Have a read of Appendix D. There's examples in there where entertainment isn't entertainment, it's travel and subsistence or strategic meetings. When I pay for a gift for clients, if I buy them the right thing, actually there are expenses that you can reclaim. What do I do about my telephone and my internet? Do I think because my mobile phone is in my personal name, it's not a business deductible expense? Well, if I do, I'm wrong, and I'm paying that money out of my net dividend when actually it should be reducing the profits of my company, saving corporation tax, and being put back into my pocket. I may pay professional subscriptions that I just pay myself. Well, in your pack, there's a link to the Revenue website that tells you all of the professional subscriptions that are tax deductible. I might be doing training. I might be doing training in an area that links and develops my business. Maybe it's a little bit of a hobby, but could it be linked to my trade? Could it be deductible? Do I pay for my own eyesight test when I go to the opticians, when I'm trying to read the print of Excel documents that people give me that I can't read because they can't print properly? And do I just go for the £4 per week working from home, use of home claim? Or do I actually rent the property that I live in at home, and I can do some really exciting things with my use of home calculation, as described as an example in your pack, without the risk of capital gains tax? The pack also goes on to talk about relevant life insurance and actually having my life insurance paid for by the company through it being set up in the right way. I might be the only director of my company, but I'm still entitled to a Christmas party. That's £150 worth of receipts for meals out. That could be put through my limited company accounts, but I'm not doing so because I'm nervy of something actually you shouldn't be nervy of. And finally, if you're paying nursery fees, are you using your childcare vouchers to their absolute maximum advantage? So there's lots of content in there and lots of food for thought, but that's always been the case that those are available. We sometimes just don't do them because we don't have the time to think about it. Now's the time to think about it and the time to become more organised, because we're not only losing corporation tax savings, we're actually going to be paying personal tax on our dividends. Okay, if technology is the reason and you feel that your accounts, systems and processes are difficult and technology could help you, as a cross-sell, if you'd like to come back here on the 5th of April at 17:45 prompt, then we are running a workshop on using accountancy technology in your business. Pieces of software like Receipt Bank, crunch boards for my cash flow forecasting. Lots of exciting things. The marketplace is developing very, very quickly for accountancy software. It's very exciting times for us. You're more than welcome to come back. The link to book is on Appendix A. So what am I meant to do from the 5th of April 2017, Linda? I need £10,000 from my business. I need that in my pocket. That's going to mean I'm a higher rate taxpayer. Well, traditionally and continued, we think about it and we say, well, there's 3 options available to me. I can declare a bonus and put it through my PAYE scheme. I'll take my additional dividend, or does the company owe me some money that I can draw back down on? So what's in your pack in the one-off £10,000 extraction section is what the total payment to HMRC is going to be with those various options. So to take £10,000 from my business and have that in my pocket, HMRC are going to collect from me, if I was to pay that as a bonus, £6,395. Therefore, as ever, dividend is my better option, because even with dividend tax in place, that payment to HMRC would be £4,814. So what we're saying is, to have £10,000 in my pocket, I'm going to have to declare a dividend of £14,814 as a higher rate taxpayer. However, if I've got that director's loan account to draw down on, do it. No brainer, no tax implications for the company or for me. So I can take that £10,000 from the company at cost. If you do have director's loan accounts in place, and you are thinking about making extractions ahead of the 5th of April 2016, give great consideration as to whether you want to lose that loan account or not at this time. Remember the marginal rate of tax. Next time you need to take money as a one-off, as a dividend, you're going to pay 7.5% more as a marginal rate of tax than if you do it right here, right now, before the 5th of April.